Welcome back, everyone. If you're relatively new to the world of investing, then vocabulary and language is really important. On my channel, I'm going to be saying quantitative analysis, fundamental analysis, qualitative analysis, and it's really important to know these investing terms in order to decide for yourself what kind of investor are you. And I can already tell from the comments section that people are confused by what I'm doing this year, so let me spell it out. In my retirement account and in my Vanguard IRA, I am passively investing. In my Fidelity brokerage account, starting soon, I will be doing a value investing series. And in my Schwab brokerage account, I will be actively investing. So let's talk about the difference between these three styles of investing. And this is really important because you need to know what kind of investor are you? What kind of investor do you want to be? And when deciding what kind of investor you want to be, you need to identify what is your strength. And the three forms of analysis that investors use is fundamental analysis, technical analysis, and qualitative analysis. Let's go through each one of these three. Fundamental analysis is what is the book value of the company. Publicly traded companies every quarter have to release financial statements. The trinity of these financial statements are the income statement, the balance sheet, and the cash flow statement. From these three documents, you can get all kinds of useful information such as earnings per share, free cash flow, book value per share, profit margin, return on equity, debt to equity ratio, profit to earnings, profit to book value, profit to cash flow, profit to sales. I am currently teaching myself corporate accounting so that I can make a series of videos explaining all of this to you. So these videos are coming soon. Now for technical analysis, we only care what is the price doing on a certain time window, the last year, the last day, the last 5 minutes. And with technical analysis, you'll be seeing a lot of candlesticks, you'll be seeing trend lines, SMAs, simple moving averages, price floor ceilings, trade volume, MACD, RSI, OBV, the golden cross, the death cross. Technical analysis, once again, is just look at what the price is doing. Do we see patterns? Can we predict what the price is going to do in the near future? And then qualitative analysis is the most intangible. What does Wall Street not yet know about this company or this stock or this service? What does Wall Street not understand about this company, stock, or service? Either an upward trend or a downward trend. And qualitative analysis can focus on, the great leadership of a company, their great product or service. Is this an emerging industry or a declining industry? Does this company have a competitive advantage that has not been realized yet? And are there any newsworthy events? Is there something in the news that's going to drive the stock to go up or down in the near future? So now that we know the three kinds of analysis, let's identify the four kinds of investors. And obviously you can make an argument that many more exist, but in this video I just want to cover the basic four of passive investing, value investing, growth investing, and active investing. And when examining these four kinds of investors, let's go ahead and say how much technical analysis, fundamental analysis, or qualitative analysis do each type of these investors use. The first kind is passive investing. The most famous example of a passive investor is John Bogle. In the 1970s, he invented the low-cost, simple index fund, and he says investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. And yeah, it's as simple as that. If you're brand new to investing, you cannot go wrong being a passive investor. If you're nervous at all, just in the first place, about putting money into the market, I highly recommend this book. This is Unshakable by Tony Robbins. And if you want to know like the nitty-gritty science and analysis of the index fund, of passive investing, John Bogle wrote a book. It's called The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. And passive investing is for everyone because you don't need to know anything. You don't have to do anything. You don't need to understand technical analysis, fundamental analysis, and you really don't want to pay attention to the news and do any kind of qualitative analysis. So we're looking at a 0% for all three of these, and it's pretty simple to explain. When you buy a broad market index fund, you're guaranteeing the lowest transaction costs, the lowest taxes, and when everybody else in the market is buying and selling, trying to take advantage of each other, you're completely removed from all that. Whatever all the other investors gain, net gain, the buyers and sellers, you are guaranteeing yourself an identical return if you just buy the entire market in a proportional amount. And for that reason, when people discover what passive investing is and when they finally understand index funds, they say to themselves, why would I ever do anything else? Why would I try to beat the market? However, the next three kinds of investors, let's go ahead and examine them. The first one is value investing, and this is made most famous by the most famous value investor of all time, Warren Buffett, one of the richest men in the world. And he says, market prices are set by herds of emotional, greedy, or depressed persons who do not always act rationally. In the short term, the markets are not rational. They don't make good decisions. So as a value investor, if you can examine the books of a company, you can find really great deals. And Warren Buffett explains it like this. Price is what you pay, value is what you get. Meaning, if you are confident that the value of a company is not reflected in the price, then you can buy $1 for 60 cents. You can get great companies at a discount at certain prices because in the short term, once again, the market is not rational. Warren Buffett's favorite holding period is forever. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. He also describes it if you were given a punch card with only 20 punches for your entire life, how selective then would you be when you made a purchase of a stock? And for value investing, it's really, the balance sheet, the income statements, the cash flow statement are really important. And they're looking at the company fundamentals, the profitability, financial health, how much debt, their management, do they have economic moats? Is this a durable, long-lasting company with a solid brand? And then finally, what is its current stock valuation? So for value investors, it really is 75% fundamental analysis. What is their book value? Maybe 20% qualitative analysis, their management, their leadership, their business model. Is this an emerging industry potentially? And then only 5% technical analysis. You want companies that other people don't want. You want beat down stocks that for whatever reason other people aren't buying or valuing appropriately. The next kind of investor is the growth investor. Peter Lynch is a good example of a well-known growth investor. He says, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. And growth investing is concerned with new technology. These are going to be small caps, mid caps that are fast growing. These companies have potential to fail. They're taking on a lot of debt. They aren't making a profit yet, and they're trying to grow as fast as possible. And potentially these companies, when you buy them, they're already viewed, according to their book value, as being overpriced. You're pricing in for a rapidly growing company, you're pricing in the next 5 years, potentially the next 10 years. These companies also don't offer dividends because all cash that they bring in, they need to reinvest in the company to keep growing. Growth investors sometimes call themselves GARP investors, growth at a reasonable price, and for growth investors, they always want to find the next FANG stock, Facebook, Apple, Amazon, Netflix, Google. And when you look at a stock like Amazon, for the last decade plus, investors or analysts have been saying, wow, Amazon is really overvalued. You shouldn't buy that. The P/E ratio right now is $95, and yet Amazon keeps going up. Amazon keeps proving everyone wrong. How much longer can Amazon's extreme growth continue? We don't know. Amazon is probably never going to fail, so there's no risk there. However, for every one Amazon, there's probably 99 other companies that expanded fast and then collapsed. And I'd love to show you their stock graphs, but there's a lot of growth companies that failed right out of the gate, and they get delisted. They get bought out and absorbed by other companies. An example I can give you is a company called X1, and this is a 3D printing company. In 2013-14, the hype was all about these 3D printing stocks. Everybody was saying we're going to 3D print clothes, 3D print food, 3D print medicine, 3D print houses. So everybody piled in to any company related to 3D printing. And the stock valuation ballooned, and then people realized that we weren't living in the future and it wasn't going to take over everything. And this company is still profitable. It's still growing. However, the share price has collapsed along with all the other 3D printing stocks. And you just see this, this hype and this buzz around different kinds of technologies, and the exact same thing happens. For 2020, let's just be honest, all of the hype was around electric vehicle stocks. Will they all maintain their current stock values? I don't think so. So for growth investors, they're probably about 60% qualitative analysis. Is this a new technology? Is this a new disruptive company that will take market share away from older, more established companies? Probably only about 30% fundamental analysis. How much debt do they have? You know, what are their sales, even though they're not profitable yet? And then only 10% technical analysis. This company is going to be sky high. It's going to be overvalued potentially. And as a growth investor, you don't care because you're expecting that growth to continue. And then finally, we have active investing. And these are day traders, swing traders, position traders. And I'll go ahead and read you the course. Buy my online course, and I will share with you my insider secrets that guarantees you will make millions just like I did. If you watch my videos, then you probably see these course sale ads, you know, before or after of YouTube guys claiming that they know the secrets and they can share them with you if you just buy their book or buy their course. I'd love to show you a picture of a famous day trader or swing trader, but there are none on the Forbes 500 list. All the richest people in the world are buy and hold long-term investors. And for that reason, investors don't consider active investors investors. They call them something completely different. They call them traders. And day trading and swing trading is pure speculation. There is no guarantee of a return. And because there is no guarantee of a return, there is no academic setting where you can train people or teach people to be day traders or swing traders. I tried going on Amazon to find a quality, reputable book, but pretty much any book you can find, it's somebody who wants you to buy their book, and then reading that book, they're trying to sell you their course and then sell you their stock tips if you want to get alerts. It's all pure speculation. There is no replicating of other people's results. The reason why with trading, the more decisions you make, the more mistakes potentially you can make. For value investing or even growth investing, you're doing the time and research in order to make the best decisions possible. But with active trading, you don't have that time, and you can't do that analysis. You have to pull the trigger in order to make your profits for the day. And the longer you do it, the more the probability is that you'll make a big mistake. And day trading and swing trading really is the world's highest level competitive sport. You can just view it as a sport. If the World Series of Poker is a sport, then day trading on the New York Stock Exchange. And there are literally supercomputers with trading algorithms that play this game. So when you jump into that market and you start buying and selling on a daily or weekly basis, you're competing with the supercomputers. So I just want people to be fair warned about active trading. And active traders don't care about fundamental analysis. It's about 80% technical analysis. What is the stock doing now? And then 20% qualitative analysis. Are there any newsworthy events or things happening in the near future that could affect the stock price? The reason why is because stocks in the short term don't act rationally. If you're only trading in the short term, then the book value of companies doesn't matter at all. You're just trying to predict what the buyer and seller market forces will do in the short term and then take advantage of it. So now that you have the vocabulary and terminology, what kind of investor are you? What kind of investor do you want to be? And you know, when you look at the options, if you're brand new to investing, you cannot go wrong. You cannot make a mistake if you're a passive investor. Just buy and hold, don't listen to the news, buy and hold forever. And for value investing and growth investing, if you watch other YouTubers, I feel like most YouTubers make videos about growth investing because these are the hot stocks. It's Tesla, it's NIO, it's, you know, whatever. So I feel like on YouTube, you're going to get a great representation of growth investing from watching other channels, which is why in the near future, I want to start a new video series talking about value investing. And I'm going to be looking for these beat down stocks that nobody else wants to see if I can find, you know, that diamond in the rough. And then with active investing, day trading, and swing trading, buying and selling options, there are people that can make a lot of money doing this. However, in my opinion, there is no guarantee, there is no science to it. You cannot replicate the results that other people get. For that reason, I will be engaging in active investing this year, but I want you to know that if I'm successful this year, it could have been a fluke. I can't guarantee anything. It is speculation. So on my channel, in my retirement accounts and my Vanguard accounts, I am still passively investing, just buying index funds. In my Fidelity account, I will be value investing, talking about individual stocks that I think are a good deal. And in my Schwab account, I will be actively trading, mostly swing trading, but I will be selling put options as well. Okay guys, if you found this video useful, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. Turn on that bell notification so you get updates whenever I post about my active trades in my Schwab account. And if you have any comments or questions, leave me one down below. I love hearing from you guys. And until the next video, take care.